It's one of the most searched for stories on the internet of recent days. Monkeys can actually pick stocks better than pretty much anyone else, or something like that. The man behind the research was Nick Motson of Cass Business School. He is here. Nick, did you really bring thousands of monkeys into Cass?
You're not the first person to ask that question. I had to explain to somebody the other day that 10 million monkeys would take up a lot of space and eat a lot of bananas. No, it was called computerized. I mean, it was a random experiment that came out of something else that we were working on. The key thing that we were looking at is how indices are constructed and how people invest passively in equities. And we were doing some research for Aon Hewitt on alternative indices, so things like fundamental indices and optimization indices and various other things that are out there. And what we found was that all of these indices outperform market cap. And being academic about it, there are two ways that that can happen. Either all these smart beta is what they call it. Smart beta indices are very, very smart, or market cap isn't a very good benchmark. So we set out to explore that, and that's how the monkey idea came up. So we programmed up monkeys on a computer. There are 10 million monkeys who randomly pick stocks. And we used the same basket of stocks, as if we lined up 1,000 stocks and a monkey picks one, and then it puts it back, and then it picks another one, and it puts it back. And it does it 1,000 times. And each time it picks a stock, it gives it 0.1% of a weight. So 1,000 times 0.1, all of these monkeys are 100% invested in equities. Theoretically, they could pick the same stock 1,000 times, but that's extremely low probability. The average monkey will pick each stock. It's like winning the lottery. There's a very, very low probability of it happening. And once we'd run this, we found that all of our 10 million monkeys pretty much beat market cap indices, like the equivalent of the S&P 500, but with 1,000 US stocks, which seems to be the result that everybody's latched on and the newspapers have been printing stories about for the last week.
And this is going back over 4 decades.
Yeah, we started in 1968 and we end in 2011, so it's 43 years. And it's the 1,000 largest US stocks. So we picked a sample which was common for all of the strategies that we looked at. So the monkeys were doing the same things as a market cap index, a bit like the Russell 1000 largest US stocks, and minimum variance indices and various other techniques that are out there.
But this is really important because in recent years, active investing has taken something of a hammering. Beta has become much more important. And what you're saying is actually this doesn't work. It's not going to simply work to buy a tracker index.
What we're saying is that over the last 43 years, maybe, well, definitely, weighting the stocks by market cap has led to a lower return than you could have got by doing other things. And that's the reason that the research was started. Pensions are pouring lots of money into passive strategies, but not necessarily just market cap strategies. And we want to know how good these strategies are. And if they're pouring them just into market cap strategies, and retail investors have been buying tracker funds and ETFs, maybe they're not the best strategies, or should we say they haven't been the best strategies? We can't say what's going to happen next. There are reasons for outperformance and underperformance, but yeah, it certainly looks like it's not been the best investment so far.
But interestingly, you're not making an argument in favour of active investing. You're still saying that ultimately computers are going to take over the world.
Or monkeys. I think one of the questions is, well, one thing that academics have studied for the last 20 years is that active management hasn't provided the returns for investors, and the main reason for that has been fees. You can beat the market by 1% a year, but if you charge an investor 1.5%, they're still worse off. So this idea of chasing alpha has kind of died a death, and people have moved towards passive investment. And I think that some of it has been reinvented now, as instead of saying alpha, it's smart beta. And it's been smart about how you capture that beta that's available in equities. It is amazing that the industry is still moving forward after all this time and still coming up with new ideas. And it's also interesting that we can go back and back test all of this stuff. And we're not really saying that these people have picked through the data to pick the best strategies, because all of them have some fundamental or academic reason why they should work. A good example would be the fundamental indices, which are marketed by a company called RAFI. What they do is they weight their stocks by book value or sales or dividends or things like that, actual fundamental values. And they come out very, very well in the back tests.
Nick Motson, thank you very much.
Thank you.